Welcome back to Caveman Capital. Today we discuss the inevitable. For decades, you have been saving in your traditional IRA or 401k. You planted the seeds, you watered the crops, and the government left you alone. But there was always a catch to this deal. The government is your silent partner. And at a specific age, that silent partner wakes up, looks at your account balance, and says, "Pay me." Today we are talking about required minimum distributions, or RMDS. This is the moment the tax bill finally comes due. Many retirees view their IRA as a savings account to be touched only when needed. The IRS views it differently. They view it as deferred tax revenue. They do not care if you need the money for groceries. They require you to withdraw it so they can tax it. Let's clarify the age rules, because Congress keeps changing them. As of 2026, if you were born between 1951 and 1959, your RMD age is likely 73. If you were born in 1960 or later, it pushes to 75. But do not guess. Check the date. If you miss this deadline, the penalty is severe. It used to be 50%. It is now 25% of the amount you failed to withdraw. Think about that. If you were supposed to take out $10,000 and you forgot, the IRS takes $2,500 just as a punishment. It is an expensive mistake. How is the amount calculated? It is based on your account balance on December 31st of the previous year, divided by a life expectancy factor set by the IRS. As you get older, that factor gets smaller, which means the percentage you must withdraw gets larger. At age 73, you have to take out roughly 3.7% of your portfolio. By age 80, it is over 5%. By age 90, it is nearly 9%. The government wants to ensure that this account is drained to zero before you die. They want their tax money now, not later. Here is the trap. You do not get to choose which dollars are taxed. Every single cent of a traditional RMD is taxed as ordinary income. It is not capital gains. It is taxed at the same rate as your wages were when you were working. This sudden injection of taxable income can trigger the tax torpedo. It does not just increase your income tax. It raises your adjusted gross income, which can make up to 85% of your Social Security benefits taxable. It is a domino effect. It gets worse. If your income goes too high, you hit the IRMAA cliffs. These are surcharges on your Medicare Part B and Part D premiums. Because you were forced to withdraw money you didn't need, your health insurance costs suddenly double or triple. So, what is the strategy? How do we defend the cave against this forced harvest? The first rule is to understand that you do not have to spend the money. You only have to withdraw it. The IRS controls the distribution, not the destination. If you do not need the cash for living expenses, do not leave it in your checking account to be eaten by inflation. Move it to a taxable brokerage account. Reinvest it. Buy stocks, or ETFs. Reset the clock and let it grow as capital gains. But if you want to lower the tax bill, you need a sharper tool. The most powerful weapon for RMDS is called the QCD, Qualified Charitable Distribution. If you give money to charity, this is your best friend. With a QCD, you tell your IRA custodian to send the money directly to a qualified charity. It never touches your bank account. Because of this, it does not count as taxable income. It satisfies your RMD requirement, but it keeps your AGI low. By keeping your AGI low, you protect your Social Security from taxes, and you avoid the Medicare surcharges. It is a triple win. You help a cause, you satisfy the government, and you keep your tax bracket from exploding. But you must follow the rules strictly. Another strategic option is the QLAC, Qualified Longevity Annuity Contract. You can take a portion of your IRA, up to $200,000 in 2026 terms, and buy an annuity that starts paying you later, say at age 85. Why do this? Because money moved into a QLAC is removed from the RMD calculation. You are effectively hiding that money from the IRS formula for a decade. It reduces your mandatory withdrawals today, lowering your current tax bill. Now, a warning about aggregation. This is where people get confused. If you have 5 different IRAs, you can calculate the total RMD for all of them and take the money from just one account. This gives you flexibility. However, this rule does not apply to 401k plans. If you have 3 old 401ks from previous jobs, you must take a separate RMD from each specific 401k. You cannot aggregate them. This is why we often recommend rolling old 401ks into an IRA to simplify your life. What about Roth IRAs? This is the one safe haven. Roth IRAs do not have RMDs for the original owner. The government already got its tax money up front, so they leave you alone. This is why Roth conversions before age 73 are so powerful. If you are in your 60s, look at your tax bracket. It might be cheaper to pay taxes now on a voluntary conversion than to be forced into a higher tax bracket later by RMDs. You are choosing to pay the tax on the seed rather than the harvest. But if you are already taking RMDs, be careful. You cannot convert an RMD to a Roth. You must satisfy the RMD first, pay the taxes, and then you can convert any remaining money. The IRS always eats first. Let's talk about the still working exception. If you are 74 years old, but still working for a company, and you have a 401k with that specific company, you might be able to delay RMDs from that specific plan until you retire. This does not apply if you own more than 5% of the company, and it does not apply to your IRAs. It is a narrow exception, but for those who work late in life, it can delay the tax pain for a few more years. The psychological mistake many seniors make is spending their RMD because they feel flush with cash. They treat it like a bonus. It is not a bonus. It is a liquidation of your principal. If you spend it all, you risk running out of money at age 90. You must view your portfolio as a finite resource. When the government forces you to sell shares to pay the RMD, you are selling assets. If the market is down, you are selling low. This is sequence of returns risk forced by law. To mitigate this, keep 2 years of RMDs in cash or short-term bonds within your IRA. When the RMD is due, you simply transfer the cash. You do not want to be forced to sell your best stocks during a market crash just to pay the IRS. Automation is your safety net. Most custodians allow you to automate your RMD. Set it to calculate and withdraw automatically in November or December. Do not rely on your memory. If you get sick or forget, the 25% penalty is unforgiving. Also, be aware of the widow's tax. When a spouse dies, the survivor usually files as single the following year. The tax brackets for singles are much tighter, but the survivor inherits the IRA and the RMDs. This means the same amount of income is jammed into a tax bracket that is half the size. The survivor often sees a massive tax increase. Planning for RMDs is not just about you. It is about protecting your spouse when you are gone. Let's summarize the caveman strategy. 1. Know your deadline. 2. Calculate accurately. 3. Use QCDs if you give to charity to erase the tax income. 4. Reinvest what you don't spend. 5. Automate the process so you never pay the penalty. The IRA was a great tool for accumulation, but in the distribution phase, it is a liability. You have a mortgage payable to the IRS, and the interest rate is your future tax bracket. Manage it proactively, or it will manage you. Do not be passive. The default path leads to higher taxes and higher Medicare premiums. The proactive path preserves your wealth for your family. Primitive logic says, keep what you kill. In modern terms, keep what you save. Review your accounts this week. If you are approaching 73, talk to your CPA. Set up the plan now. Do not wait until December 20th to try and figure out how to transfer money. The systems get clogged and mistakes happen. Thank you for watching Caveman Capital. We navigate the maze so you don't have to. The government wants its share, but there is no law that says you have to give them a tip. I am the caveman. Stay smart. Stay solvent. Disclaimer. Before you go, a necessary legal warning. I am a content creator, not a certified financial planner, tax professional, or licensed insurance agent. This video is for educational and entertainment purposes only. The rules of RMDS and taxes are complex and subject to change. Your personal situation is unique. Always consult with a qualified professional, a CPA, or a licensed local agent before making any decisions regarding your money or retirement accounts. Do your own research. Do not rely on a caveman for your legal defense.